Hey guys, my name is Shashank Udupa, and in this video, in this talk, I'm going to talk to you about the different types and different ways where you can invest if you're a millennial. Now, I'm not going to give you the same mumbo jumbo that a lot of people in the market give you, but I'm going to try and teach you how to turn your mind in a different way or how to think from a slightly different perspective. I'm going to try to make you understand concepts that are not very generic, okay? So it's slightly different for you guys as well. In this talk, I want to walk you through that journey with my own personal experiences in the finance realm, how I did some mistakes when I was a millennial and I was starting to invest early on in my life, and hopefully you guys can learn from my mistakes and actually lead a better financial life quite early on. Okay, so in the next segment, we're going to talk about 5 different points that I feel are like golden rules for millennials to start investing very early on. Rule number 1, don't go for that quick money that everyone's making out there. Now, I'll give you an example, and this has happened just now in the recent market, where a lot of people try to find these opportunities and try to find these ways and methods to make a quick buck very fast. Now, millennials I know have little less patience. They want everything very quickly. But what I'm trying to tell you is don't try to optimize for this quick money, quick gains. Optimize for long-term wealth creation. I know a lot of my friends right now with the cryptocurrency boom and the IPO bubble that's also happening, a lot of people are investing in IPOs only for listing gains. As soon as the IPO comes out in the market and starts listing, they make 30, 40, 50% returns, remove the money and keep it in their pocket. That's it. That's done. If you look at what the cryptocurrency market is doing right now, we see Dogecoin becoming a thrill because someone is tweeting in the other half of the world. But a lot of people don't care what the fundamentals of Dogecoin are. People are just investing in something so that they can get that quick gain or quick money out and put it in their pocket. Now, all the big guys in the financial industry, okay, all the people whom you have seen in the past, Warren Buffett, Rakesh Jhunjhunwala, all these guys have not built their empire or built this kind of wealth over a period of 1 year or 6 months. If it was that easy, everyone would do it. What I'm trying to tell you is think from a different perspective. Try to look at it from a long-term view. Let's go directly 20, 25 years into the future and you make a plan and say, okay, you know what? When I retire, when I'm 60, I want this much capital at the end of my 60th year, and that is what I'm going to work towards backwards. And when you start doing this long-term planning, you look at something that is fundamentally strong that will survive the test of time and not just go for something that is a quick money or a quick gain. Okay, so for all the millennials out there, this is the golden rule, number 1 rule. Let your friend make that extra 10,000, 15,000. He might get lucky once, he might get lucky twice, but maybe on the 3rd time, he might just fail. And I don't want you to do that. So I want you to invest for a long-term period of time and keep tracking whatever you're investing in, whatever instrument it is, keep it for a very long period of time, because trust me, if you know how compounding interest works, you will make a lot of money over a long period of time. Now, my second rule, and I call this the 8% rule. Now, I'll tell you why I call this the 8% rule. First thing a lot of people need to understand, and I told you right at the start of this video, we're going to change our perspective of finance. I want you first to understand how percentages work and not just look at monetary value in terms of rupees. I'm not looking at 10,000, 15,000. I'm going to look at how percentages work because that is more important. Now think about this and why I call this the 8% rule. When I just started earning, when I started making my first salary, a lot of people told me, including my close family members, my society people, they all told me that FD mein invest karo, it is very safe for you. And I said, okay, cool, maybe that is good, right? Let me invest in an FD which was giving me around 6.5, max 7% at that time. This is for a year. But then I realized, being a finance student, I realized that, you know what? The inflation rate in India itself varies around 5 to 7%. Now see, I'm only talking about percentages, not any kind of INR income. If the inflation rate is around 4 to 7% fluctuating, I need to at least beat inflation. Then I realized a big issue, that a lot of people in India look at returns. Okay, they say I got 10% returns and they're very happy, but they don't look at it from an absolute return perspective. They don't look at how much inflation has increased over a period of time. If this year the inflation was maybe 5%, then I need to make post-tax returns of at least 7-8% to be even good enough. So don't look at only monetary value. Even if you make some kind of money, okay, if you make 10% a year, cut the tax from it, you might make 9% a year, and then say, you know what, Shashank, I'm still not happy with this because it's 9%, but the inflation this year as calculated by India was say 5%, so I've actually made only 4% return in the entire year. Now you decide whether 4% is good or bad for your long-term plan that you made. So I call this the 8% rule because you need to understand whenever you're investing in any instrument, first realize, is it at least beating the fixed deposit? Okay, is it beating my inflation? If these two things are happening, only then invest in a particular stock. If not, stay away from it, go for a higher percentage rule. Now, my third thing that you need to look at quite closely is something known as interest. Now, interest can be good and can be bad. And you guys have heard of interest as, if you invest in a fixed deposit or a savings deposit or any kind of scheme, you get so much interest. But you've also heard interest in another context where you have to pay EMIs, which is also in interest. You have to pay the interest back when you take a loan from someone. Now, I want you to understand this term of interest very clearly when you are investing early on in your life. And I did this very same mistake because I'll tell you why. When I'm in college, I'm getting a lot of money from my parents for, as pocket money. So I don't have anything. I just have to take their money and spend it. And I used to do that a lot. Now, once you start earning your own money, okay, all shackles are off. You're completely free and you can do whatever you want with that money. And that was when I went and got a credit card. Mistake number one, because credit cards are not bad, but if you don't know how to use them, you rack up big debt. You rack up a lot of interest. And I got a credit card, superpower in my hand, kept buying all the fancy phones, no cost EMI had come at that point, so I just kept buying. But everything has a cost, and I ended up having my credit card bill extremely high, more than 2 times my entire monthly salary. And that was bad because the interest now was highly more than what I was actually earning. So this was not a good thing for me. Now, then what I realized, I had to pay back my entire interest, entire EMI, cut off my credit card completely for a bit until I know how to manage my money well. And then I realized, dude, in the early days of life, you need to make money work for you. So you need to put money in a place where interest is your friend, not your enemy. And currently in my year, interest was my enemy and I was actually paying interest to someone else. So that was not cool. So what you need to do early on in your life, as soon as you get a job, as soon as you start making some kind of money, start investing this in money so that you make interest your friend and don't keep buying something on an EMI or buying something that's out of your budget and make interest your enemy. If you understand how to make interest your friend, trust me, he'll be your best friend for life and you'll make a lot of money with this friend. So always invest in something and get interest to work for you. Make money work for you. You don't sit and work for money so that I have to keep paying it back. Now, point number 4 that I realized very early on, and I have to tell you guys this, please do your own research. Now, when you start making money, and remember the point which I spoke earlier where you see a lot of people making that quick money, the first rule, where everyone is trying to make quick money, you will get a lot of friends who will come and meet you and say, you know what, Shashank, there's this amazing stock that you need to buy. Definitely, kal 20%, it will go up by 20%, for sure 100%. Now, that might be true, but just because he told me, I'm not going to invest in that. And I did this same mistake when I started earning very early in my life. I just heard people saying, buy this, FOMO, right? You buy that, you'll lose out on that 8% if you don't buy this right now. And maybe it might go up. Okay, maybe he was right. But I didn't do any fundamental research and I was banking on that guy. Maybe he's right for the first time. Maybe he's right the second time. And I'll keep investing more because what he's saying. And then the third or fourth time I'll start losing money and that will just create a bad cycle. So if there's a friend, and we all have this friend, if there's a friend who comes and tells you, you know what, Shashank, invest in this stock, will give you 15% up. I'm telling you, it's amazing. You should tell him very clearly that, okay, cool, I get what you're saying. Let me do my own research and let me see if it aligns with my risk of how much I can invest. Because maybe for you, 10,000 rupees is a big amount. Maybe for him, it's a very small amount. Maybe he's done this 2-3 times before. So you need to understand how your risk, proportion is. You need to understand whether it's good enough for you to invest in something like this. And if he's investing, doesn't mean you have to invest, because don't fall into that weird FOMO. Always in the stock market or any market, whenever you're investing your hard-earned money, be it real estate, be it stock market, be it any financial instrument that is making money for you, please understand that you need to do some fundamental research. Okay, you need to figure out, I'm putting this money inside. Is it a good thing or is it a bad investment? Is it sticking to my rule that I'm making more than 8% or not? And am I doing this for quick money or am I doing it for my long-term vision of 60 years? And if it ticks marks all of these things, then you go buy it. If it doesn't, your friend might call you the next day and say, hey, you didn't invest, I know I got 20% more. It's okay. Tell them that's fine, man. I'll see you after 15 years and let's see who has a bigger net worth at that point. Now, the last thing that I look at, and this is very important for everyone who's investing in the stock market for the first time, don't get scared. And I'll tell you why. It might seem daunting, it might seem scary when you're investing in the stock market, newly investing in the stock market. And when even though I was a finance guy, when I started my career, even though I was a finance guy, I was an investment banker. But the first thing when I had to go invest, the biggest question was which demat account to open, which bank account to open in the first place, what are the brokerage charges, how do I invest, what are the different type of orders there, because all these things were not taught in B school or were not taught in my college, right? They don't tell me what a market order is or what, GTT order is. No one talks about intraday trading. No one talks about technical analysis. No one talks about fundamental analysis. And that was a big learning for me as well. And I was scared. I'm like, okay, how do I identify what is good and what is bad? There is so much information out there. And each stock is in a particular sector. Now, what I'm trying to explain here is that if you don't have any knowledge in the stock market, and if you say that, I don't have the time to do this research about the stock market, it is still fine. It doesn't mean that if you don't know this, you should not save or you should not start investing. If you don't know all this, it is completely fine, because there are two instruments that is very easy for this, and it is built for people who don't have the time or don't understand the stock market, and they are called mutual funds and exchange traded funds, which are ETFs. Now, what mutual funds do is basically it's a fund that is managed by someone else, okay, some experienced guy who's putting money for you and growing your money for you. It's like you have this guy who's growing money for you, and you have to pay him a small amount which is negligible when it compares to how much money he'll actually make for you. So here, you don't have to think too much. You just need to pick out a good manager, a good fund, and invest in that. If you think even that is too annoying, Shashank, I don't want to do so much research as well, then just go with what the Nifty index is going. There's something called as Nifty index. You can invest in ETFs and you can just follow the market, because we all know that over a long period of time, Sensex has gone up, Nifty has gone up, and it'll keep going up. Small things will keep going up and down, agreed. Don't look at that. Look at a long-term picture, 10 years into the future, 20 years into the future. And if you think that, everything is too confusing, then just invest in the index and it'll go up. And a lot of big people also recommend investing in indexes. If you don't have that patience, or, you don't have that thing of understanding how the stock market works. So don't worry, don't get scared. There are a lot of resources out there for you to learn from. Take your time and then start investing, but please do invest early. So guys, these were my 5 points, my key learnings that I understood when I was young. I made these mistakes, so I don't want you guys to make these mistakes. So I put out in a way where you can understand quite easily, quite simply. And this is for everyone who wants to start investing when they're young. And trust me, it is always good to understand how compounding interest works. Start investing when you're young and early. Don't wait, for a very long period of time. I know a lot of things will tempt you in life when you start investing early. Right? You'll find this amazing phone, or your friends are going to go, and there's so many things that keep happening around. It's okay. It's fine. I would say a beautiful benchmark would be whatever you earn, okay, just save 10% of that, or maybe 20% of that, and remaining 80% of whatever you earn on a monthly basis, it is for you to enjoy, do whatever you want. No problems, no questions asked. But only that 10%, just try to make this discipline of saving. It doesn't matter whether it's 500 rupees per month, but trust me, if you build this discipline very early on in life, it will be amazing and super beneficial for you. And trust me, you'll thank me one day because of this. So I hope I was convincing enough to change your mindset about how money works. It's not about money, it's about percentage. Understand how interest works. Don't get scared about investing, and start early as soon as possible, because if I could go back in time and tell my younger self that, these 5 points, trust me, it would have been a beautiful life right now. But again, I did that mistake, and I don't want you guys to do that mistake. So please educate yourself and start investing soon. Thank you.